Welcome back to Hedge Heads, brought to you by American Federal Bank. John, what are we talking about?
Exciting new episode right before the end of the year. This is a New Year's episode, I think. We got Theta Farmer on here, and he likes to sell options. So he's going to dive into all that, and we're going to, I'm sure, get off topic and talk a lot about different things. But let's go into it with Theta.
Thanks for having me.
Welcome to Hedge Heads, where hosts John Prischmann and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, Theta and John, normally I start with you, John, but with Theta here, we're going to focus on him today, and I'm going to sit back and just enjoy what you guys have to say. But let's start with the 2026 outlook, huh?
Yep, you've heard our outlooks. Let's hear Theta's. He's got money on the line, so he's got more riding on the line than we do, and we'll get a on the ground report. What do you think's going to happen in 2026?
Well, for farming, I don't think there's a whole lot to be excited about except government payments. We've got some payments coming out end of February. It's midterms in 2026, so I expect some more payments probably in August or early September.
They wouldn't ever buy votes.
Never. That doesn't happen. Well, market-wise, I think we got a big crop out of Brazil coming. We've got big supplies in the U.S., outside of a weather scare, I don't think these markets are going to go much of anywhere but grind down. Hopefully by the end of the year we get a new RFS EPA ruling on biofuels, but other than that, there's not a whole lot of a story anywhere.
So you're giving up, is what I'm reading between the lines. You're giving up before we've even begun. Even I don't think I'm that negative. But it is what it is. He's not lying about any of it. The South America is probably the biggest problem. But it's the surprises that you have that usually provide the little windows. And are you prepared for, like, if you have your price targets, if it gets there? Do you want to see the weather window like midsummer to see what the yield's going to be? Or are you already pulling the trigger? Because I've seen a ton of guys talk about locking in 26, have locked in, gonna lock in. And I won't talk a guy out of locking in a profit, but it seems like there's just no one thinks this is gonna go up to better prices, or if they do, they think maybe 10 cents is what we got here. And then you look at the calendar, and it's usually up from here. So do you have higher targets? Do you buy cheap calls? Market your stuff, buy cheap calls, looking for that big weather event? I mean, or are you just a guy that says, "Hey, this is a good price for me. I'm going to take it," and it is what it is? I mean, how are you doing this?
Well, for old crop, I was looking at the markets today, and for corn, it doesn't really pay to store corn in my local area. Basis doesn't really improve that much to July. There is carry there in futures, but it's not really enough to justify the storage costs, especially relative to options where I could just buy the calls and own it on paper and move the physical this month. So I do like to have some upside, especially when vol's cheap right now. I think we're at like 17% implied vol for July.
Yep.
So might as well take the opportunity there. New crop wise, I haven't sold anything yet. I haven't hedged anything for 26. But I always like to keep that window open, and I usually move or put a position on in late April through mid-June.
Yep.
Because that's just kind of when seasonals peak. So that's the strategy I put at seasonals.
Last year, I think, was one of the last years that I remember that it was kind of punishing if you didn't market really early. Like it was a February, and that was the highs for December. Highly unusual, but I almost feels like guys feel like that it could disappear on them really quick, almost more like they're overreacting to what it normally would do. Meaning it might not do a lot, but it might stay the same price. Why not see a lot more things go on? Like things can happen in South America, even if it looks like a big crop. In 2016, it got rained on and ended up being a smaller crop. I think it was 16. Ended up not being able to harvest out of the field, and he had a very large rally going into May. And I just feel like giving up on the upside before you see anything isn't worth probably the 10-cent range that we're going to go into. Like, are we going to go to 450 in December 26th? Sure, we could, but then it's likely to bounce up to 470. So why take yourself out of the game before you see essentially anything? You've seen a good portion of the South American weather so far, but still you haven't seen anything. So I'm kind of in your boat. I wouldn't be giving up on this. Then once you get to these prices, like you say, you're maybe considering, are you considering pre-buying the calls before it goes up? Like I've been talking about September with the idea that you get some call on, and then once we get to these levels, market your grain, and then you have your call already established. Where I'm having a hard part is how to pay for this premium. I don't want to just pay 22 cents for like a 470 call. I'd rather be buying a $5 put, September put, in the money put like I did a couple years ago for 33 cents. Give yourself a 460, 467 floor and have your upside wide open. So I'm trying to think of combinations that are going to work. But like you said, we're kind of in this dead zone where it's not quite high enough to do anything, and it's too low to do anything. So you're kind of just stuck. But from where I sit, though, I'm seeing a lot more people move on this crop a lot earlier than you would normally see. And not that they don't know what they're doing. I mean, it's just when people move in large groups, like you're seeing, generally I find that they have marketed far too early. When you have good prices and nobody wants to do it, or it's not quite high enough and they think it's going to go higher, those are the markets that tend to fall. So it's, we know the fundamentals, and it's going to take something to probably change it. The January report, do you have any feelings on that?
No, I don't really pay attention to the reports besides quarterly stocks.
Yeah, so January's not a big report to you.
Yeah.
That's really thrown a lot of guys off over the years. A lot of guys think they're going to make yield cuts. They add yield. Last year they cut a bunch of yield, and they shouldn't have. And we ended up with a lot more corn. So it can be a very misleading report. I feel like they're probably going to cut yield, or at least the trade thinks they're going to cut yield, and we'll probably drift up into that, I would think. But it's also hard because you have basically a neutral position in corn for the funds, meaning they could go either direction, commit money either direction, and then beans are heavily long. So I wouldn't call this an ideal setup by any stretch. So when it gets to these low volatility time periods, what do you do as an option seller? I mean, where are you? Are you just taking vacations?
Yeah, I'm on full retirement right now. I haven't done much of anything in the past 3 months just because Vol's not there. So, I mean, selling straddles or strangles probably would have worked just because the ranges were so low, but it's like selling a ticking time bomb.
Yeah.
If you're too big and you're shorting Vol like that, when Vol's already compressed, you're playing with fire, and eventually you're going to get burned if you stick around long enough.
Yeah. And I like to sell time. I'm in the camp that, let's say you sell, let's just say a $7 wheat call in whatever month, just pick a month out there, and you get 25 cents for it. Are you a guy that likes to get your full 25 cents? I'm a guy that's looking like, if I'm selling 25 cents, I want to get 18 of that and then get out.
Yeah.
Where do you land on that? I'm not a stay into the last day of option seller.
The key to being a good options trader is to manage your positions, not just put it on and forget it.
Yep.
So like when you sell your call, have a target in sitting when you put the position on. Like as soon as you put the position on, put an order into exit.
Yep.
Because a lot of times all that value could erode, you could be profitable, and then something changes in the market, and then you end up losing money if you don't take it off.
And your goal with selling options is to add more money to the bottom line or your physical sales. I'm just trying to make money. Your goal.
Yep.
Yeah. So let's say you have 460 locked in. It just wasn't a good year like last year. You're trying to generate more income coming into the farm off the option sellers, covered by the bushels that are unpriced.
Not even necessarily covered by bushels. Because eventually, like if you think 460 is a high value for corn, or it's overvalued, you could still sell calls, and that could still be a profitable trade.
So you're in the camp, and this is where it gets kind of murky and gray area and dangerous. But you're in the camp, as long as you continue to grow corn, you could always use hedges by rolling if if you were overhedged. And of course, nobody's saying to overhedge anything, and that's how you get in trouble. But I do feel that way for a corn guy. If you're growing corn, you're always going to be able to use those high hedges. There hasn't been any markets besides maybe 10 going to 11 and 12. where you basically have had like multiple years where that would have been painful. And that involved the lowest ending stocks ever, followed by the worst drought that we've seen in many since 1987. And he even then had a hard time staying up for 3 years.
Yeah.
And that was the most extreme that I've seen the market get. So, so if you get hung with a couple of these short extra calls, which hasn't happened, but if it did, you would plan on rolling it out to maybe your 27 sales. Is that what you're talking?
Yeah, or just eat the loss, or just double down and add more. This did happen in when Russia invaded Ukraine. I was shorting wheat calls because the vol was so high. This looked great, but it did move against me very rapidly, and I lost a lot of money. But I just kept rolling it out, and going higher strikes, and eventually I recouped most of that money.
And that's another market that always comes down, but that one can be exceedingly painful.
Well, most commodities in general seek the cost of production. So if you have enough money and you can last long enough, the prices will eventually come back down.
Yeah, and this is not recommendations by any stretch. This is just Theta style and what he does in the markets, and it works for him. And we talk about this a lot. You have to find what works for you. What he does doesn't work for me. First of all, because I'm not covered by the bushel. Secondly, he just he thinks in a different way than I think about the market. Although we have a lot in common with things that we look at and do in the markets, you still, on your option side, that's your journey and you're willing to take additional risks, for your farm, but you still know how to manage the risk. At the end of the day, you are getting out if your position's wrong.
Yeah, absolutely.
Yeah.
And the key to doing this really is managing your position and being restricted on how much capital you're using.
Yeah.
You never want to use more than 25 to 50% of your capital that you're willing to dedicate to trading.
Yeah, and I always talk to when we talk about this often, talking to the banker and being on the same page of what the program is. And you'll find a lot of bankers that are very flexible if ultimately, it's covering bushels. But it's just, it hasn't been those markets where it's even created this opportunity for guys that know what they're doing. So it gets frustrating, much less a guy that's just dependent on a raw cash price. It's got to be a really tough market. Generally, you have these markets that are kind of quiet, and you can generate, this additional revenue maybe on uncovered bushels and keep the ball rolling. And really, everything's been at a standstill. It flared up a little bit there with the China deal. Some of the volume came back and the volatility, and there was opportunity. And then Ryan and I were talking about how excited we were. The markets were changing. And then right back to what we are today, where you're, looking for any idea to make it better. It's like, well, let's sell some March calls. Then you look at the March calls and, on the grain that you're storing right now, and what can you get? 5 cents for something right near the money.
Yeah.
And then why give up the upside for so little money? And then you go around in circles and there's nothing to do. Do you sell options and do you like the short term? Are you a high vol? So crude oil is a great market for this. Are you a high volatility, short time frame guy? You like doing stuff like that too?
Well, I like to think of it in terms of filters. So if volatility isn't high, I'm not really keen to this strategy. Volatility was great. It was really high through 21 through 23.
Yeah.
It's fantastic. But right now it's low, so it's not that great. But I always tend to look for higher volatility options first.
Yeah.
And then I like to look at lengthwise, like to go out 40 to 55 days, just because the theta curve, the theta decay is steepest from 55 to 25 days.
Yes. So
another point of managing a position is if that time has passed and we're down to 20 days, then I'll still manage it early. I'll move the position out in time.
Yep.
So I kind of like to stick to that 55-day range and then close it around 20 days.
Yeah. So. Yeah, and I'm a big fan of that too. It's just you want to get where that burns, the premium burns off, and the guys that are long options will understand this really quick. It just one day all of a sudden it looked like a good position. It was holding its value fairly well, even though you might not have even been right. And then all of a sudden this call that you bought just starts deteriorating really rapidly. He's on the other side of that. That's what he's selling. He's looking for that zone where it starts falling apart. And it's really psychological. It's really it's not that many days anymore. Is it really going to get to that price? And then all of a sudden, nobody wants to buy those calls anymore, so you have to sell them for a lot less to get people to buy them, and it is a market. And then you're on the other side of it, looking to burn that off, and once it burns off, then that's when I like to exit. I don't like those last 2 weeks where it can be, you got not much left, and then you have a lot of action that could, you're basically setting yourself up for loss. Yeah, you could get that 2-3 cents, but you're trying to get $100 for, a possible $1,000 loss, especially in soybeans.
Right.
Corn I don't worry so much. I feel very good exiting wheat calls or puts early, and also on the bean side of stuff. It feels really good to sneak out of there with a month left and getting most of that money out of there. Because honestly, I don't know what the percentage is, but a high percentage of the time, it's going to come off those lows just because beans move that much.
Yep. Well, I think I made a bet with Ryan a week or two ago. I own a beer now. He was talking about buying calls and
just
corn.
Collecting beers around here.
But options were cheap in corn. Ryan thought it was a good idea to buy corn calls. I said probably not, but he was right. We rallied over Christmas. He won his beer, but if we would have went a week later, looks like I would have won the bet.
Yep.
So
well, and that's timing. And John and I had a similar bet last year too that I won a beer off, and
I was right, but I was in the wrong time frame.
In the wrong time frame, and it has to do like what I'm hearing, especially as you talk, and John and I talked about this a lot last week on the podcast too. Is you need to have a plan for everything. Like know why you are doing this before you do anything. You need to lay out. Why are you doing this, and what's your expected result, and what's your expected stop or loss, or where are you getting out, whether you win or lose. And that's what I'm hearing. Everything that you do is very finely tuned plan. But that was the same for me on corn. I've watched this, right? I knew what was probable, not guaranteed, right, over the next 3 days. Now I meant to get out on Friday and got busy, and the market closed before I got out, and it paid off that I couldn't get out till Sunday night, Monday. But it could have easily gotten the other way because I went outside my plan and forgot about it.
Sure. And options were super cheap.
They were super cheap. The only reason I did it was a 4-cent option that was 2 cents in the money. Yeah. It felt like, what's the worst it could be in 2 to 3 days? Right. 2 cents, I mean,
yeah.
And that's where you
lose 4 cents.
You could lose 4 cents is the absolute worst, right? The most likely is you weren't going to lose more than 2. It's corn. It's not going to move down 20 cents over the weekend unless something down 20 cents from here is highly unlikely. Up 20 cents could be a world event or something like that could easily do it. And so you need to weigh all those things, no matter what trade you're doing or what market you're looking at. Probably true throughout life.
Yeah.
But
so I was going to ask you, there's going to be guys that obviously get lost in this conversation. I knew that was going to happen when Theta comes on. We're going to talk volatility, and guys are going to get lost because they're just beginning. So if you're a beginning guy, where are you starting when you're learning about this? Obviously, I've known you kind of since you started a little bit to some degree, and you kind of took to it fairly quickly. And I've seen a lot of other people start. Everybody's kind of in a different spot. Where would you, if you know not much about this and you want to learn, or maybe you haven't had luck and you've been in the markets, where are you starting? I know my advice is always, the first instinct is to go online and look and try to figure out what other guys are doing online. And I think that's a dead end. I don't think that really is really helpful. There is some things out there that are helpful, but where are you starting if a guy's trying to get into it and wants to learn more, but really genuinely doesn't know where to go?
I'll have to come back with some specific books, but there's some option theory books by, I think it's Hull, or some dynamic hedging books. But if you are going to get into options, I just say start small. Come May or June, just sell a call in corn and just watch what happens. Just keep your size small. Just watch how it acts. Maybe buy a call now before spring and just watch how it behaves. I focus on learning on what implied volatility means to option pricing and how that factor changes the value of an option.
Yep.
I'll come back with some books and some better sources for
and we'll put it in the description when we get Mike's books that he likes, and it is a very difficult thing to break into. But then once you get into it and you're comfortable with it, that's where it starts paying off. And when did you start? Probably 10 years ago, do you think?
2020, right before COVID.
Okay, so yeah, fairly recently. Yeah, you do need to see, and I know you haven't seen a market like the wheat market. If you're a volatility seller, you do have to see something like the 2020 or 2008, 2009 wheat market to really appreciate what these markets are capable of, because none of it's all very risky. But that market in particular did things that no one thought it was possible in spreads and in volatility. I mean, it got to the point where it ruined the exchange. I mean, the Minneapolis Grain Exchange, the puts and calls were never the same after that happened. I called down there one day and there was no offers on calls at one point. Not a single person willing to sell any call at any price. And then you had spreads like March, May. There was $6 to, I don't know if it got to $9, $6 to, I think it was $9 spread difference between the same crop year.
That's crazy.
And it happened in a few days. So it's like you have seen a lot of stuff like the Russia and Ukraine and how fast things can change that you cannot predict. But you don't get those markets that often either, and wheat has been one in the past that's done that, and beans have gotten pretty wild.
And natural gas is a famous one for option sellers.
Yeah, optionsellers.com. Yeah. But you have seen a lot of what the market can do, and you've gotten lucky in this window. You've seen a lot of bull markets, and you've seen some bear markets, and then you've seen world wars. And so you've seen this. In this little 5-year window, there's been a lot of different looks to these markets, a lot of different looks.
Yeah.
And I wouldn't say it's made it easier at all. I mean, there's been a lot of volatility, but one bomb going off in the port at one point in Odessa would, any short call, you'd just be wiped out. And then months went on, and then they would bomb, and then the market the market didn't care. So there's just a lot of different things. It was so hard because grain prices were high, and it felt like the right thing to short, but you just couldn't because of the threat that it was going to double in price if it intensified. But in those 5 years, you have seen a lot of stuff. But I can tell, I've been around a lot of guys and a lot of guys that trade and a lot of guys that trade daily. And you're a little different deal than a lot of people. You seem to have caught on very quickly, where the learning curve is generally a lot of bumps and bruises and many years, and then you get to where you are a lot more comfortable. You are, and that's why we like to have you on the show. You were able to get through that curve fairly quickly. But and what Ryan said and what you said earlier, I think money management's probably the most important thing out of anything.
Absolutely.
Yeah. And that's what keeps you in the game, basically.
Yep.
Because you're going to be wrong. I mean, you're going to have
I'm wrong all the time.
Yeah. and you're willing to get out. And that's really, I think, probably the number one thing for a guy to learn is you just need to get out of things that aren't going good. Or if you have a plan with a banker and he's going to back up the hedge and it's like planned out with a banker, that's a different deal than what we're talking about.
Yeah.
But overall, I mean, so you're looking to get involved in the markets, but you're just not, these aren't the markets that you like. Do you go outright long positions, short positions? I mean, is that stuff that you do in grains, or are you just almost always options?
I will short like corn or soybean futures. I did that last summer.
Yep.
I rarely go long because I'm already, long in the bin. I'm long next year's crop and the year after that. So I'm like triple long on paper. So I don't need to get longer, I guess.
Yeah.
Yeah.
No, and that's understandable. I find that what happens a lot is guys want the price to go up, they produce it, and then they end up buying calls. And the calls are promoted a lot because they sell well. Like, we think corn's going higher, call me and let's get involved to buy calls. And I think that's where a lot of guys start out. They buy calls and they're basically just doubling up stuff they don't need to double up. And in addition to that, corn calls are exceedingly hard to make money in.
Yep.
They're almost always overpriced.
That's one reason why I think when people go to options, they're buying volatility, but what they really want is delta exposure. They want exposure to the price direction of corn going up, but you're buying a lot of time. You're buying that future volatility, and corn isn't always volatile.
Yeah.
So a lot of times guys that do buy calls at the wrong time, or if it falls already high, they end up losing money. So you could buy a call, corn goes up, and you still lose money on the call.
Yeah, and that's what happens. I see this time and time again. It's ironic. It actually goes the direction they think it's going to go. And two things happen. It doesn't move fast enough, and it doesn't move far enough. But it does get profitable. The funny thing is, the calls often get profitable, but it gets to be, you buy something for 12 cents, and now it's worth 16 cents. So it's like, I did all this, and I planned
after corn went up 20 cents.
Yeah, and I got 4 cents. That's just not quite profitable enough for me to take. Then you kind of sit on it. Next thing you know, it's worth, 19 cents. And then all of a sudden it's worth 11 cents and you've lost. And that's what I see over and over in corn calls. You just don't have those directional, continuing to go up markets. If you bought March calls last year, you did very well because essentially you're just forced out on the high. But if you would have bought April calls, or May calls, a lot of guys probably would have lost money on that simply because they stayed in and then went right back to where it started from. So I find long corn calls, if you're not willing to take profits, and very modest profits, you'll have a hard time, where it's the exact opposite in beans. I don't think beans are like that market at all. So do you prefer beans, corn, or wheat for your selling?
I like corns because it doesn't move so volatile as beans. It seems to be implied as always greater than historical vol.
Yeah.
For beans, it kind of seems like the opposite, so kind of stay away from that.
Meaning they're underpricing soybean options pretty much at all times. Yep, and they're overpricing the corn options. Yep. And then wheat's kind of a crazy market where you can never tell what's going on there. Yep. Sometimes it's way overpriced, but really for what it could do overnight, it's always underpriced. Very similar to gold and silver. Before this latest move, that the vol was just incredibly expensive for what just happened. The gold bugs and the silver bugs say this could explode at any time. It could double. And that's why the calls are always so terribly expensive. And that's why Victor Niedenhofer sells S&P. He's a famous hedge fund guy. Sells S&P puts because same thing there. The market could crash at any time. So he'll collect these premiums for years and years and years. And then it does finally crash, and then it wipes them all out, and then he starts all over. And he's done that a couple times. So you got to know your markets that you're selling in. I mean, you really got to know the personalities. And wheat is great for selling calls, but I'm kind of in the camp that you really want to be covered by your physical bushels in wheat, because it can be a very dangerous market to do that in, because it can keep going. A lot of markets don't, but wheat is one of them. It'll go to sleep for years, and then it'll go a lot higher than you think it can go.
Funny you brought up the S&P crashing. That's exactly how I made most of my money this year, this spring. I was selling puts on the crash and then converted it to futures and rode it up through May.
So you're all over these markets. Yeah, and it's you want to it's walking that edge. You want to be where the volatility is, but you also don't want to be a part of the story like the optionseller.com guy.
Yeah.
That what was it? It was crude oil calls and natural gas calls at the same time on a giant spike that did them in. So it's incredibly dangerous to do, but a lot of options expire worthless. One of my least favorite sayings, though,
just think though, if they could have rolled those for like 2 years, they would have got negative oil.
Yeah, right.
They could have made it all back. They just had to roll it, like Mike said. You got to have enough.
The bankroll wasn't big enough. Yeah.
It didn't make it the 2 years till crude went negative.
I'm gonna guess a lot of those people in those accounts didn't even know their account could go to backwards, much less to zero and beyond,
right?
Because it was like printing money for them till the day it wasn't. But one of my least favorite sayings, though, is 90% of options expire worthless. And it's just the most misleading statement ever. There's a lot of option strike prices everywhere. And I actually just learned something the other day. When you go out really far, somebody was going to sell a 27 week call, but they didn't have, it went 720, it went 715, 720, and then it went to 740. They didn't have 730, and the order was for 730. You can, those can be added at pretty much at any time, and you can basically add a strike price. So I had the 730 added, but when you look at all the strike prices and all the ranges, like you can buy $9 corn calls right now if you want. Of course, a high
You can
percentage.
just write me a check.
Yeah. Of course, a lot of them are going to expire worthless, or 90% of them. So it's just really misleading for guys getting into selling options that like 90% of the time you're going to be making money. It is not anywhere near that. When you look at all the strike prices, it's all about timing and knowing what you're doing when selling options. It has nothing to do with 90% expire worthless, because you're going to find the one in the 10% category, and it's usually pretty painful, that don't. And then when guys do sell options, it's usually a lot closer to the money. You're not selling those really far out of the money ones.
Yeah.
And you just don't win 90% of the time. It's definitely a position you have to manage. You have to know what you're doing. And you really got to recognize when it's overpriced and time it right. I mean, that's really what the game's about.
Yep, absolutely.
And seasonals factor in are a huge part of it. But May into June has to be one of your favorite times of year, isn't it?
Oh yeah, busy planting, busy selling calls. Yeah,
Yeah, I mean
it's my third harvest.
it is it's a time period that can really make you from unprofitable just on the farm to profitable in 5 weeks.
Yep.
And that happens almost every year. But it did not happen last year. Last year was a hard year, and it was very quiet. It fell in February, and there was not much of a chance to sell anything.
Yep.
So we'll leave with some final thoughts here on where we're headed into 26. So you're in the camp that it's going to be tough, and you're going to try to manufacture something or make it work when you get there. Here's what I think. I think that there's so much. I'm hearing so much of this Market 26 corn talk. It's got to be wrong. And I'm not saying don't do it, always market. But I'm hearing more than I've heard in a very long time, getting aggressive, getting these sales. I've even heard talk of 27 sales. And after what I just saw silver do, and I'm not saying because silver went up, corn has to go up, but it could just, if it attracts more money and oil starts moving up, then corn could, with silver being where it is, corn could move up very briskly. So all these years where everybody's worried about inflation exploding and, they don't want to market because of it, all of a sudden it looks like that could actually be happening where Wall Street sticks in a bunch of money. If you see oil go up, I think corn could go a lot higher than where it's going right now because of what we have going on. You throw in a weather scare and you're going to look very silly for selling corn here. But I just am more that we haven't seen anywhere near enough. We don't know what the plantings are going to be. We don't know what the weather is going to be for planting. And we don't know where the prices are going to be, what the ratios are going to be. So when you got such, you have a price that's not attractive, why would you take out the upside at this time of year?
Right, yeah. It's not attractive.
No, and where you won't find me making this argument in June, even at this price. It's a very seasonal deal. And but I'm seeing more than ever, guys are in a very big hurry to get this marketed. And I've seen that happen recently, and that would have been 19 and 20 with a famous 3 billion bushel carryover. And before that, the other cycles, guys had marketed out a couple years, and it goes up. Not that they don't know what they're doing, but it's that herd mentality. When everybody's doing the same thing, it tends to be wrong. But I haven't seen enough evidence that everybody's doing it. But I definitely have seen more chatter than I've seen in a lot of years. Although I've seen nothing on Twitter lately because it's only the what's
Minnesota fraud.
Yeah, that's all that's in there now. So you can't really see anything else. But it's starting to break up a little bit. I actually saw a couple farmers posts today, and I think I saw one of your posts. You had a pretty funny one in there today. Yeah, busy waiting in the office. You had some pretty imaginative posts today. But anything else you want to add?
No, let's just hope that I'm wrong for 26.
Yeah, and we need to see you out there on vacation. I'm here in Minnesota. He's here right now, and he's capable of not being here. And I've been trying to talk him into going somewhere, anywhere. You have to get out of here. I'm jealous.
Hey, I'm going to Utah and California this month. So.
That's gonna be good. I mean, that's a start. That's not a bad spot to go. And then you said San Diego, maybe.
Yeah. Hopefully.
Yeah. Very nice.
Utah to drink and California to ski.
Utah. Yeah, no, it's beautiful out there. You'll have a good time. We appreciate you swinging by here today, and we're hoping that you can help because I've seen what you do. And hopefully you can start helping guys because I know a lot of guys want to know how to do this or want to know how to start, and they just simply don't even know where to begin. So that's why we like having you on, and you can kind of share your knowledge. Even though this has been a smaller window, I can tell you I've seen a lot of behind the scenes stuff, and he does know what he's doing.
Sure.
Do you want to pitch your business at all, Mike? You're sitting here.
Sure, might as well. So I do a financial analysis for guys at the end of the year too. I helped with building balance sheets and cash flow plans for the upcoming year. So it's called Radical Land Management. If you want to get in touch, you can shoot Ryan a call, and he can forward you my contact information. So,
yeah, email us at hedgeheadspod@gmail.com, and we can get you in touch with Theta Farmer if you're interested in those services.
And also, we were talking while we were waiting here for Ryan. He was coming in for an appointment, and we're also thinking. I'm trying to talk him into starting a marketing club here. We're thinking about it, but it's going to be more of a hopefully a higher quality one with like maybe a beginning marketer club, and then a more advanced one. So it's an idea we're kicking around. Of course, that would be local to this area. But South Dakota, Minnesota, North Dakota, I mean, there's not a lot to do in the winter. So, it might not be a bad idea.
Right.
You can have it as a snowmobile club that meets on the market.
Yeah, we'll meet at the old schoolhouse so they can just snowmobile in and have a couple beers, and we'll have the marketing club.
There you go. Perfect. Well, anything else, John? You mentioned oil briefly. Did you want to talk anymore? Or were there any other things that you were watching that you wanted to just put in people's ear?
I did notice the front of the oil curve was inverted.
Yes, and we did talk about that the other day. That to me that says that this is more of a push by the funds than anything else. They say a glut's coming. The market says, bring us your oil. If you store it, you're going to get less. It's not that inverted, but still, you don't see this divergence too often where you get this weak of a market, yet you're inverted. Generally, that provides some opportunity. For me, the first thing that stands out would be selling oil puts. That's been wrong, but that is a move I like to do, and a lot of producers like to do that too. You can always use crude oil on the farm or diesel, and so it is a legitimate hedge. That's where my first instincts, but I also don't like how weak it looks either. And, when it gets this weak and you get news that would make it bounce with Venezuela and all that stuff, and it doesn't bounce, that's also another warning sign. But I do like the inversions. I think that that they are telling a story there. And we didn't talk about it this whole time. Mike does like the spread trade too.
I do, yeah.
Yeah, spread trade's great.
I am looking at December 26th corn wheat. That looks attractive too.
Eventually, that's if you can time that one right, that's going to be good because corn's obviously getting very expensive relative to wheat. I find that the wheat leg, the reason why I personally don't like that one now, I like the level, is I don't like the corn short leg, and then I don't like the wheat long leg.
That's true. Yeah.
So I figure if you're spreading it in two positions and you hate both of them, it's probably not one that you should take.
In my world, those are the ones that work. If it's opposite of what I think.
Yeah. And what it really entails with wheat is that you're just buying wheat, waiting for wheat to go up, and you kind of got this little mini hedge on there with the corn. But it has been good. The Kansas versus Chicago, which we're texting back and forth, they worked pretty good. You got distracted. You were out there in California, I think. You didn't get that one on. But Mike likes spreads, and maybe next time that we're in with Mike, we'll talk more about that.
Perfect. Well, let's wrap it up there. John, you leave your number.
218-731-1578.
Thanks, John. And Theta.
They consider him a guru in the markets, but then in the women department, he gets lower scores.